The time has come. It's tax season, and if you've been buying, selling, or earning crypto, you need to report it. You might be holding your crypto in private wallets. Maybe you sold some assets last year. Guess what? That means you must report your capital gains and losses in your income tax.
Money moves fast, better stay on track. Stocks and crypto, we ain't looking back. Charts go up, we ride that wave. Big bulls run when we make that play. Hey, stack and flip and watch it rise. Millionaire mindset in my eyes. If get bought, we strategize. Stay in the game, we maximize.
Have you been trading on platforms like Binance, Crypto.com, or Coinbase? Maybe you've noticed that despite all your transactions, you never received a Form 1099 from them. So, does that mean you don't have to report your crypto taxes? Today, I'm breaking down everything you need to know about reporting your digital asset transactions, the latest IRS requirements, and different accounting methods to help you strategize your tax reporting. Before we get into the IRS rule changes, let's address a fundamental question. When do you owe taxes on your cryptocurrency holdings? Here are the main taxable events: selling crypto for fiat currency like US dollars, euros, etc. Trading one cryptocurrency for another. Buying goods or services using crypto. Receiving crypto as income, whether through staking rewards, mining, or airdrops. I'm Dr. Valdez, specializing in blockchain technology and its diverse business applications. I harness the power of artificial intelligence to deliver insightful, high-value content on a wide range of business topics, helping you stay informed in an ever-evolving business landscape. If you find my content valuable, please subscribe to my channel and comment on topics you'd like to see discussed. Now, let's delve into the upcoming changes in cryptocurrency tax reporting for 2025 and understand why it's crucial for you to stay informed. Historically, U.S. cryptocurrency exchanges weren't required to provide Form 1099-B to users, leading to inconsistencies in tax reporting. Some platforms issued forms like 1099-K or 1099-MISC, but these lacked the detailed information necessary for accurate tax filing. Recognizing this gap, the IRS introduced Form 1099-DA for digital asset transactions. Starting in 2025, any exchange classified as a broker will be required to issue Form 1099-DA to both users and the IRS, detailing all gross proceeds from sales or exchanges. So, for any taxable event in 2025, you'll receive this form in early 2026. On December 30th, 2024, the IRS published new rules requiring brokers facilitating digital asset sales to report gross proceeds starting with transactions in 2025 and cost basis starting with transactions in 2026, bringing crypto tax reporting closer to traditional stock trading. If you want to access the full document, check out the Federal Register or IRS website for TD 1002. To make it easy for you, I've included a direct link in the video description. Here are the key takeaways you need to know. First, new broker reporting requirements. Starting February 28, 2025, brokers that facilitate digital asset sales must report gross proceeds from transactions. This applies to both centralized and some decentralized platforms and NFT marketplaces. However, final guidance on DeFi is still pending. If you're new to crypto, centralized means a trusted third party manages your transactions, holds your assets, and oversees security, much like an exchange or financial institution. Think of it as a traditional bank handling your funds. On the other hand, decentralized means no single entity is in control. Transactions happen peer-to-peer using blockchain technology, and you have full ownership and responsibility over your assets. It's like being your own bank with no intermediaries in between. Second, expansion of the broker definition. The IRS has broadened the definition of broker to include entities facilitating digital asset transfers, including DeFi, decentralized finance platforms, and NFT marketplaces such as Uniswap and Aave on the Ethereum blockchain, or MinSwap or SundaeSwap on the Cardano blockchain. Third, Form 1099-DA for crypto transactions. Brokers will now be required to issue Form 1099-DA to users and the IRS, detailing sales and exchanges of digital assets. This ensures better tracking of capital gains and losses. Fourth, cost basis reporting. By 2026, brokers not only will report gross proceeds, but also need to report cost basis. Aligning crypto tax reporting with traditional stock and securities reporting, this means tracking how much you originally paid for an asset will become even more critical. Gross proceeds refer to the total amount received from selling a digital asset. Cost basis is what you originally paid for that asset. The difference between the two determines your taxable gain or loss. What are the implications for DeFi and self-custody users? While the new rules primarily target brokers, self-custodied wallets and peer-to-peer transactions still exist in a regulatory gray area. But that doesn't mean they're off the radar. The IRS has already signaled that further regulations may be introduced to address decentralized platforms, so this space is evolving. And speaking of evolving, IRS Oversight is ramping up. With stricter enforcement efforts and more transparency in crypto reporting, the days of flying under the radar are numbered. Failing to report crypto transactions could now lead to serious penalties. What does it all mean to you? If you trade on exchanges like Coinbase or Binance, expect more detailed tax forms in the future. But if you use DeFi platforms, stay tuned. New reporting rules might be coming your way, but know that you're legally obligated to report all taxable digital asset activities, even if you don't receive a 1099 form. The IRS requires taxpayers to disclose income, gains, or losses from digital assets on their tax returns for the year the transactions occurred, regardless of the amount. This includes selling, exchanging, or receiving digital assets as payment. Now, let me get real with you. Reporting crypto transactions sounds simple until you actually try to do it. When I bought my first digital asset, I thought, okay, this is easy. Just a few trades, right? If only it were that simple. As I kept buying, selling, and transferring crypto across wallets and exchanges, things got messy really fast. Tracking everything? An absolute nightmare. Every time I tried reconciling transactions across platforms, it felt like solving a puzzle with missing pieces. And the worst part? Time zones. Talk about frustrating. The records were completely out of sync, errors everywhere, and manually fixing each entry felt like an impossible task. So if you're struggling with crypto tax reporting, trust me, you're not alone. When I first got into digital assets, I had the same question. How on earth do I report all of this for taxes? At first, it was simple. Just a few trades here and there. But as I started making recurring purchases, trading based on price movements, and transferring assets between multiple wallets and exchanges, things quickly got complicated. Trying to keep track of everything? That was an entirely different challenge. It felt like piecing together a financial statement with missing data points from multiple sources, all of which used different formats. Now, you might be wondering, why not just use one wallet? That's a discussion for another video, but the short answer is security. Keeping all your assets in one place is risky. One breach, one compromised key, and you could lose everything. Distributing assets across multiple wallets helps mitigate that risk. So, in my search for a structured way to track all my transactions, I turned to Crypto.com Tax, a tool designed to calculate capital gains and losses and generate tax forms. Back in 2020, this was one of the only free crypto tax solutions available. But there was a catch: no technical support. Instead of real-time assistance, users had to rely on a self-guided online manual. For those unfamiliar with tax software, this was not a seamless experience. It took hours of trial and error to understand how to upload and correct transaction data properly. But the real challenge wasn't just using the software. It was reconciling transactions across multiple wallets. With hundreds of transactions occurring over different platforms, ensuring that every transfer aligned correctly was far from straightforward. And here's where it became even more complex: time zones. That's right, crypto wallets operate on different time zones depending on where the company is headquartered. Let's say my Crypto.com wallet operates in Eastern Standard Time, and I send Bitcoin to a privately hosted wallet in another time zone. When I later downloaded my transaction records and uploaded them into the Crypto.com tax tool, the system recorded the Bitcoin as received before it was even sent. This led to errors, discrepancies, and in some cases, transactions being flagged as if assets were sold when they weren't even available. Manually adjusting hundreds of transactions was simply not practical. In the next section, we'll discuss solutions to simplify crypto tax reporting, minimize errors, and make compliance far more manageable. Given the challenges of manual tracking, I knew I needed a better solution. That's when I started looking for crypto tax software. At first, I used Crypto.com Tax because it was free and simple to start with. But in late 2023, they discontinued the service, forcing me to search for an alternative. Some platforms provide gain-loss reports but they do not offer dedicated tax software or generate IRS tax forms like Forms 1040 or 8949 that the tax.crypto.com used to generate. At the end of the day, the responsibility to track and report your transactions falls on you. Now, I do use tax software, but I won't disclose it just yet. And no, this is not a paid disclosure. I want to be clear. The decision to use any tax software is yours. This is not financial advice. It's about knowing your options. Now let's move on to our next subject. Did you know you can choose how you calculate taxable gains? Here are three main methods. The first method is FIFO, or short for first in, first out. FIFO is the IRS default method. The first crypto you buy is the first one you sell. This method is straightforward, but can result in higher taxable gains if your earliest crypto purchases were at lower prices. The second method is LIFO, or short for last in, first out. This method allows you to sell your most recently bought crypto first. This can reduce taxable gains in a rising market, but requires meticulous record keeping. The third accounting method is HIFO, or short for highest in, first out. This method prioritizes selling the most expensive assets first. The advantage? It minimizes taxable gains in certain scenarios, potentially lowering your tax bill. However, it demands detailed tracking and may require extra documentation. Choosing the right method depends on your tax strategy and financial situation. If in doubt, consult a tax professional. Here are some key takeaways. Crypto tax reporting is getting stricter. Stay prepared. Do your research before committing to tax software, and track your transactions proactively. And now let's talk about the tax software I ultimately chose. Remember, this is not an endorsement. Always verify software capabilities before using it. After testing multiple options, I settled on one that met my needs. It integrates well with tax services, handles multiple wallets, and have an easy template to upload transactions for wallets that are not supported by its platform, which are minimal, by the way. After extensive research, I chose CoinTracker, not because this is an endorsement, but because of its integration with H&RBlock and its ability to support multiple wallets without requiring manual uploads. However, when I met with my tax professional, I discovered that despite CoinTracker's listed partnership with H&RBlock, the integration wasn't seamless. My tax professional couldn't access my records through H&RBlock's system, which caused unnecessary complications. Moral of the story? Do your own research and verify software capabilities before committing. If you are interested on my review on this software, leave a note on the comments below. Navigating the taxation of digital assets can be complex, but with the right tools and knowledge, you can ensure compliance and peace of mind. Remember, staying proactive and informed is key. If you have questions or need personalized advice, consider consulting a tax professional familiar with cryptocurrency regulations. Thank you for joining us today. Don't forget to like, subscribe, and share this video with others who might find it helpful. See you next time.
Money moves fast, better stay on track. Stocks and crypto, we ain't looking back. Shots go up, we ride that wave. Big bulls run when we make that play. Hey, stack and flip and watch it rise. Millionaire mindset in my eyes. Chips get bought, we strategize. Stay in the game, we maximize.